Ladies and gentlemen, if you genuinely want to grasp when the next major global conflict is truly approaching, stop fixating on the latest carrier strike group deployments or fighter jet patrols near contested waters. Those are theatrical displays, assets that can be surged forward for exercises, diplomatic signaling, deterrence posturing, or pulled back to home port within days or even hours. They are designed to be visible, to project strength, to shape perceptions. Real strategic intent, the kind that signals an irreversible break in preparation for sustained confrontation, is never paraded in open ocean. It is buried in the slow, cumbersome, almost glacial movement of sovereign debt holdings. Debt is the invisible backbone of the existing world order. Unlike warships, it cannot be repositioned overnight without triggering massive market dislocations, forced liquidations, or outright panic. Moving hundreds of billions in treasury positions takes months or years of careful execution to avoid crashing prices and spiking yields against your own interests. So when the world's second largest economy begins unloading the sovereign debt of its chief geopolitical rival at a velocity that defies conventional portfolio management logic, it is not merely adjusting risk exposures or chasing better yields. It is systematically severing the last remaining financial lifelines that have kept the two economies intertwined for 2 decades. It is preparing for a scenario where those holdings could become worthless, or worse, weaponized against the holder. We must perform a meticulous, line-by-line dissection of the most recent Treasury International Capital (TIC) data published by the U.S. Department of the Treasury. This report is deliberately dense, buried in footnotes, country breakdowns, and custodial adjustments that most financial media outlets never bother to read beyond the top-line aggregate. That is a mistake. The devil, and the warning, is in those details. The headline number is stark. Official Chinese holdings of U.S. Treasury securities have fallen to $688 billion as reported for October 2025. To casual observers, this still appears substantial. In isolation, it is. But relative to the historical trajectory of U.S.-China financial entanglement, this represents one of the most dramatic ruptures in modern economic history. We have rolled back to levels not seen since May 2009. 16 years of progressive deepening integration have been erased in a compressed timeframe. At the zenith in mid-2013, during the height of what analysts once optimistically termed Chimerica, the symbiotic recycling loop, Beijing's treasury position peaked at $1.32 trillion. That enormous stake effectively underwrote a significant portion of America's persistent fiscal deficits. Dollars earned from China's export machine were funneled back into U.S. debt, suppressing American long-term interest rates, enabling cheap consumer borrowing, and allowing U.S. households to purchase record volumes of Chinese-manufactured goods at artificially low prices. It was a closed, self-reinforcing circuit that stabilized global growth for nearly a generation. That circuit has now been intentionally dismantled. From peak to present, China has offloaded nearly 48% of its peak treasury holdings, more than $600 billion sold into the open market. The truly alarming dimension is not merely the cumulative volume, but the precise timing and market conditions under which the accelerated sales have occurred. Late 2024 through all of 2025 marked one of the most punishing periods for the U.S. Treasury market in recent memory. Bond prices were deeply depressed, yields volatile and trending higher, meaning every seller was crystallizing meaningful realized losses. In disciplined institutional asset management, you do not willingly lock in double-digit percentage losses on a depreciating instrument unless one of two imperatives is in play: acute liquidity pressure forcing immediate cash needs, or a fundamental reassessment that the asset has transitioned from safe haven to high-risk liability. China faces no liquidity squeeze. Despite well-known domestic real estate challenges, the country continues to generate enormous global trade surpluses. Foreign exchange reserves remain among the largest on the planet. Beijing is not short of dollars or forced to sell for cash flow reasons. The data therefore points to one inescapable conclusion: the Chinese leadership has made a deliberate, top-down strategic judgment that U.S. treasuries are no longer a reliable store of value. They have been reclassified internally as a geopolitical vulnerability, a latent hostage asset that could be neutralized or confiscated with administrative action at any moment of heightened tension. This reclassification is the clearest post-2022 sanction evasion signal observable in open-source financial flows. Recall the speed and scope of the Western response to Russia's 2022 invasion of Ukraine. Within hours, approximately $300 billion of the Russian central bank's foreign exchange reserves, funds custodied in New York, London, Frankfurt, Paris, and other Western financial centers, were frozen or immobilized. Russia had treated those dollars and euros as sacrosanct emergency reserves. Overnight, they became inaccessible. Beijing watched the mechanics of that operation unfold in real time, conducted internal wargames around the implications, and arrived at a stark realization. In any serious Taiwan contingency, South China Sea escalation, or broader great power clash, the remaining $688 billion, and whatever incremental holdings persist, would not function as a reserve asset. It would function as leverage held by the adversary. The instant coordinated sanctions are activated, that position can be locked, diverted, or rendered valueless. Beijing is no longer prepared to maintain that asymmetric exposure. They are exiting with urgency, accepting realized losses of 10 to 20% or more on the face value today to avoid the near-certain risk of a total wipeout tomorrow. This is not routine portfolio optimization. This is a strategic divestment with the character of a burn notice. Sovereign wealth managers and central banks normally sell gradually, in small tranches, through dark pools or intermediaries to minimize market impact and avoid driving yields higher against their own book. Yet the pace of the recent acceleration, nearly $12 billion liquidated in October alone, suggests Beijing has shifted priorities. Speed and finality now outweigh market stability considerations. They want the capital removed from U.S. jurisdiction before any escalation window slams shut and exit becomes impossible. The macroeconomic consequences for the United States are structural and profound. For 2 full decades, Washington enjoyed an almost unlimited ability to run historically large fiscal deficits because a massive, price-insensitive buyer always stood ready on the other side, China, mechanically recycling its trade surplus into treasuries irrespective of prevailing yield levels. That buyer has now reversed polarity, from dominant net purchaser to dominant net seller. The resulting supply glut and demand vacuum in the U.S. Treasury market is enormous and growing. Who steps in to absorb the hundreds of billions China continues to release? Who finances America's ongoing trillion-dollar-plus annual deficits now that the single largest foreign creditor has turned seller? The TIC data provides the answer. The burden is being shifted onto nominal allies, most visibly the United Kingdom and Belgium, with Japan and a few others playing supporting roles. UK holdings have surged to record levels above $750 billion in late 2025. Positioning Britain in near parity with China as the second largest foreign creditor after Japan. This is extraordinary when viewed through economic fundamentals. The entire UK economy is roughly 1/6 the size of China's, and Britain runs chronic current account deficits rather than surpluses. It does not generate excess dollars organically. The inflows are almost certainly financed through leverage, City of London financial engineering, redirected capital flows, or outright borrowing. Britain is effectively pledging its own strained balance sheet to serve as a temporary backstop for the U.S. Treasury market. Belgium's reported position, fluctuating between $320 billion and $370 billion, follows an analogous pattern. Belgium itself lacks the organic surpluses to justify such buying. What appears as Belgian accumulation in TIC statistics is typically custodial activity channeled through Euroclear, one of the world's dominant international central securities depositories. Euroclear provides a layer of anonymity and operational plumbing that allows other central banks, sovereign wealth funds, and institutional accounts to accumulate treasuries without direct attribution. The synchronized spikes in UK and Belgium holdings precisely as China accelerates sales point to coordinated G7 burden sharing. This is not spontaneous market demand. This is geopolitical conscription, Washington leaning on partners with varying degrees of pressure. China is dumping. If you do not step in and warehouse this supply, the treasury market fractures, the dollar system fractures, and our collective security umbrella can no longer be guaranteed. It is financial mutualization under duress. The Achilles heel of this arrangement is finite allied capacity. China could absorb unlimited treasury supply because it earned fresh dollars through genuine export surpluses. The UK, continental Europe, and Japan do not enjoy that structural advantage. They are already grappling with elevated public debt, anemic growth, energy transition costs, aging demographics, and domestic political constraints. Forcing them to absorb ever larger volumes of U.S. debt drains liquidity from their own economies, redirects capital away from productive domestic investment, and heightens internal fragility. The West is weakening the periphery to artificially stabilize the core, a classic late-stage imperial symptom. While this paper reshuffling sustains temporary calm in the Treasury market, China is using the proceeds of its liquidation to migrate wealth into the one realm the U.S. Treasury and SWIFT system cannot reach: physical, tangible reality. When treasuries are sold, settlement delivers dollars into custodial accounts. Beijing no longer wishes to hold those dollars long-term. They are now perceived as sanctionable, traceable liabilities exposed to inflation and potential seizure. The capital is therefore being aggressively redeployed into hard asset accumulation at a scale and speed that defies peacetime commercial logic. The evidence is visible in cargo manifests, port satellite imagery, commodity import statistics, and strategic reserve buildups. Gold accumulation has been relentless. Official PBOC purchases have continued unabated for over 18 consecutive months. Unofficial signals from Shanghai Gold Exchange delivery volumes indicate the true scale is far larger. Dollars from treasury sales are routed through London and Swiss markets to acquire physical bars and coins, which are then airlifted or shipped east. Gold is the ultimate non-counterparty asset, immune to keystroke freezes or jurisdictional control. Energy security is being fortified at unprecedented speed. China imports roughly 70% of its crude oil, making it acutely vulnerable to naval interdiction of key maritime choke points. In response, strategic petroleum reserves have been filled to near maximum capacity. Independent satellite analysis reveals extensive new surface tank farms and underground storage caverns under construction. Total commercial and strategic crude stocks are estimated to approach 1.5 billion barrels. Enough to cushion the economy through months or potentially years of severe supply disruption. Base metals and strategic minerals show the clearest war-footing signal. Domestic real estate activity, the traditional largest consumer of copper, remains deeply depressed, with housing starts and construction permits at multi-decade lows. Yet copper ore and concentrate imports remain near all-time highs, approximately 28 million tons in 2024. This mismatch is not inventory rebuilding for civilian use. It is deliberate stockpiling for electrification infrastructure, munitions production, drone components, battery manufacturing, and next-generation military systems. Parallel patterns appear in cobalt, lithium, nickel, rare earth elements, and other critical inputs. Food security has been elevated to fortress status. China produces 20% of global GDP but controls only 7% of the world's arable land. In response, it has amassed 60 to 70% of global corn and wheat stocks according to USDA estimates. Sufficient grain reserves to feed the entire population for over a year without a single external shipment. Calories are being prioritized over financial yield. This represents a profound strategic reorientation. A nation anticipating prolonged peace maintains wealth and efficient, interest-bearing financial instruments that maximize return on investment. A nation bracing for major disruption willingly accepts negative carry and storage costs to build physical buffers that cannot be neutralized by financial warfare. Holding hundreds of millions of tons of copper or barrels of oil generates no coupon, it costs money to warehouse. Yet in a contested environment, those assets deliver unmatched return on survival. Beijing is deliberately trading short-term fiat-denominated losses for long-term strategic autonomy. Western commentary frequently highlights the realized losses on treasury sales as evidence of poor timing. They sold at the bottom, billions evaporated. That critique is myopic. China is no longer optimizing for mark-to-market fiat ROI. It is optimizing for sovereignty, continuity, and resilience in a potential kinetic scenario. Selling a bond position at an 80% paper loss today to acquire oil that could prevent economic collapse under blockade tomorrow is not a loss. It is asymmetric strategic gain. The liquidation itself is the funding mechanism for this transformation. Proceeds from the old dollar-centric system are being exchanged for the raw materials of the new fortress economy. The data flow is clear and accelerating. China sells allied capacity, absorbs physical stockpile swell. For investors and ordinary citizens alike, the takeaway is stark: the U.S. Treasury bond is no longer a risk-free asset in any meaningful sense. It has become a geopolitical instrument dependent on the continued willingness of increasingly strained nominal allies to warehouse supply that no longer has a natural economic buyer. The classic 60-40 portfolio framework assumed treasuries would always serve as reliable ballast. That assumption is now obsolete. Practical positioning protocol. First, shorten duration aggressively. Long maturity treasuries and long duration bond ETFs are most exposed to structural upward pressure on yields as supply overwhelms demand. Even modest increases in long end rates can inflict severe price damage. Concentrate any fixed income exposure in ultra-short maturities, 1 month to 6 month treasury bills, where duration risk is negligible and behavior approximates cash. Second, follow the smart money into real assets. China's actions provide the clearest roadmap. Convert paper claims into physical commodities. Gain exposure to energy producers, base metal miners, precious metals, and agricultural inputs, not as speculative trades, but as inflation-resistant and conflict-resilient stores of value. Third, maintain constant vigilance on the Allied backstop. Monitor the British pound, Japanese yen, and euro for signs of stress. A sharp currency defense move by Japan, yen intervention requiring treasury sales. A UK gilt market tremor, or European banking sector liquidity strains would indicate the periphery can no longer sustain the core. That moment marks the point where artificial stability gives way to disorderly adjustment. The $688 billion remaining is not merely a balance sheet line item. It is a visible countdown clock. China is methodically disentangling from the U.S. financial architecture. They are accepting controlled pain today to preserve optionality tomorrow. The current market calm is artificial, propped up by political coercion and finite allied balance sheets. When that support reaches its limit, the repricing will be abrupt and severe. Reduce long-duration exposure. Build positions in tangible assets. Watch the flows. The financial divorce is already executed. We are simply waiting for the final distribution of assets. You now know what to do. The protocol is active. Act accordingly.